Good morning, good afternoon, good evening, wherever you are in the world. I'm Nicolas Véron. It's my pleasure to introduce this new session of the Financial Statement series at the Peterson Institute for International Economics. This time I even have the logo behind me. Today we'll discuss securitization, and particularly with focus on what's happening in the European Union. It's a very lively debate. There was a report, for example, a year ago by the European Securities and Markets Authority about the EU securitization market. At the global level, the Financial Stability Board issued a consultation report. Probably we'll discuss it a month ago or two. And our two speakers, of course, are particular specialist of it. Emmanuelle Assouan has led a lot of work at the Banque de France. The Bank of France actually organized a conference earlier this year on securitization in the European context. The publication, I think, is out soon. And Sebastian Mack has published a cautionary policy brief at the Delors Center back in March, which I recommend every attendant to this session to read. Emmanuelle Assouan studied at Sciences Po in Paris in the early 1990s, and she joined the Bank of France, or more specifically its banking supervisory arm, which at the time was called the Banking Commission, and then moved to central banking operations and infrastructure in 2002. She made a lot of different contributions to that area of the Bank of France, and went back to supervision for a moment in the early 2020s until last year as deputy head of what is now the Autorité de contrôle prudentiel et de résolution, the Supervisory and Resolution Authority within the Banque de France, and in January last year was appointed Director General for Financial Stability and Operations at the National Central Bank. Sebastian Mack studied at University of Würzburg, also at INSEC Business School in Paris, at University of Würzburg. He, I think I have to mention, studied under the leadership of Peter Bofinger and got a master's with distinction in 2011 on European business administration, economics, and European law. He worked a few years in the private sector for KPMG, the audit network, and then in 2015 joined the European Parliament staff as policy advisor to Sven Giegold, MEP, who is now back in Berlin. And in 2020, Sebastian also was back in Berlin, joining the Delors Center, which is now affiliated with the Hertie School of Governance and is started as a sister organization to Notre Europe, the Jacques Delors Institute in Paris, and leads their research on financial services policy. With that, Emmanuelle, I'll hand it over to you, and I think I will move your slides.
Thank you very much, Nicolas. Good morning, good afternoon, good evening to all. I'm very pleased and very honored to be invited for your financial statements in order to share the Banque de France perspective on securitization. So maybe if I do start on the next slide, I would like to maybe state why Banque de France and also ACPR, Autorité de contrôle prudentiel and resolution, the supervisory arm of Banque de France, is very keen to work on securitization. It's a threefold story. First, it's a central banker story. As you might know, in the Eurosystem monetary policy framework for collateral, securitization is one of the asset classes which are allowed and which can be mobilized. Actually, among the mobilized assets of the Eurosystem counterparts, almost 20% of those assets are as asset-backed securities, which is quite a large part considering the fact that ABS are only 3% of the universe of assets eligible. So a strong deviation towards ABS, which makes the Eurosystem one of the biggest investors, risk takers on securitization in Europe. To tell you a figure, it's like 300 billion euros, which are mobilized for collateral purpose for monetary policy, and it's like 50% of the eligible collateral for ABS, which is actually mobilized. One addition on my side, Banque de France is playing a particular role in this regard, since we play a role which is we have been tasked to evaluate the asset-backed securities for the rest of the euro system, and it has been like 15 years that we are doing that. So having a specific technical expertise in terms of valuation of ABS. There's a second aspect which is very important as far as securitization, which is the fact that we are very keen to look at the best ways to fund the real economy. And here we have a very specific aspect which is related to climate. As you know, Banque de France, like all the Eurosystem central banks, are very keen, because of their mandates, both monetary policy mandates, but also financial stability mandate, to get the right transition as far as climate, in order to preserve price stability and financial stability. And for that, we have to help in order to fund the transition. And the needs for transition in Europe, it's like 620 billion euros per year for the next coming years. And they will not be funded very easily. We will use, and we will have to use some excess savings that we have, which represent up to 4% of the European GDP, but it will not be enough. And we have to make a little bit of room on the bank's balance sheet. As you know, in Europe, banks do represent 80% of the funding of the real economy. And for that, we have to continue, for the transition funding, to continue to use banks' balance sheet. And to make a little bit of a room on banks' balance sheet, the securitization is very worth contemplating. We have made some calculations, but others have made other calculations. And if we take the hypothesis that we can securitize like 20% of the asset of commercial banks, notably in France, but also elsewhere in the euro system, it can free up like 13% of the EU GDP, so meeting a large part of the needs for the transition funding. Last thing, we are also interested in securitization because it's a risk for investors and originators. And as you know, which originate securitization, and the insurers which invest in securitization, or which should be natural investors in securitization. So we are very keen to have a risk management in that regard, which is resilient and meets our expectations as far as adequate risk management. So a very balanced view. And for that, we consider that, nevertheless, that considering the benefits of securitization, the risk profile of securitization, and we know that it is well regulated because of the different developments, that the standards and regulation from the banks and insurance perspectives are not designed properly, and are not taking into account adequately the different risk factors that should be in. And it is still too penalizing as far as the regulatory requirements, both for insurers and banks, and still a little bit too blunt because of the scars of the GFC, the last global financial crisis. So why from a regulatory and supervisory perspective, and thank you, Nicolas, it is not at the right level, according to us. The very first aspect is related to the securitization regulatory aspects by itself, and notably the disclosures which are required from the issuer, the originator perspective, but also on the investor perspective. And here, because we use those disclosures, we use the different data points, we know that the disclosures requirements are too burdensome, that more than half of the data disclosures data points requirements are not useful from an investor perspectives that we are, because we are doing the valuation on behalf of the euro system, and that there could we could consider a strong simplification of the different data templates. This could come with some addition related notably to climate data, which we consider should be very useful in order to incentivize green securitization. There's another point in addition to disclosures, which regards the originators. We have a lot of different avenues to consider in order to restore some proportionality in the risk assessment of securitization. The very first one is related for the originators, the banks, which originate and which sell the securitization. There's a lot of complicated processes with the significant risk transfer, which allow the securitization originated and sold to be unbundled, to be unbundled from the balance sheet of the originator. So in order to allow for the capital requirements decrease. We are confident that there are some ways to consider in order to alleviate the burden of SRT proof. There's another aspect which is very important for originators. Among them, a lot of are have been retaining the securitizations that they issue. They keep it, notably for collateral purpose, and the risk weight associated to securitization is a little bit not sensitive enough to the underlying risk of the underlying assets. So the granularity of the loans, the seniority of the different tranches, or even the different the credit quality of the different loans making the securitization. The model is linked to the model and agency risk, which is linked to the securitization and to the tranching. And here we can make a better balance with the underlying risk versus a little bit less of agency risk. Maybe there is another aspect which I would like to develop on the previous slide. On the investors side is about Solvency II and the insurers shocks that shocks that insurers have to play for the capital calibration. What we have is shocks which are much more penalizing for the different, even the most senior tranches of securitization than for the different the whole portfolio of assets being constituting the securitization. And this is according to us a real flaw, from a risk perspective that should be corrected. On the next page, and the last one, we consider that regulatory aspects are not the sole ones to consider, and that we should be mindful to be very active in terms of operational aspects. So the very first one is to use one possibility which has been opened last November by the EU Commission to use the EU green bond label for securitization, which would allow to take some, assets, not green, not especially green, brown or green, whatever you want. And because of the use of proceeds system, if 85% of the use of proceeds is invested in green projects, make it a green securitization. I think it's a possibility that has not been used much and should be by the different stakeholders. Last thing is about the facilitation from an operational perspective. Securitization is still very concentrated from the originator perspective. We have seen that it is still from an investor perspective, because Banque de France is the biggest investor in Europe in that regard. We should make securitization more accessible both to originators and to investors by maybe creating a platform. It has been done in other countries just to let smaller banks, and not only the biggest ones, to be in a position to originate. That's a project that we contemplate, and that could be built upon new technical devices, including DLT, blockchains, which could be of big help if we addition the ambition to develop green securitization, and thus a lot of different climate criteria. I'm done. Thank you very much.
Thank you so much. And you mentioned DLT, that was for distributed ledger technology. There's a lot to chew on. Let me unshare the slides.
And very much, Emmanuelle, for these introductory remarks. I think that set very well the scene, and thanks to Nicolas for inviting me to join that discussion. You said it, securitization is a hotly debated topic right now, features high on the agenda of the Capital Markets Union. We have seen several reports just this year, Noyer letter, and most recently the Draghi report out today mentioned securitization as well. Emmanuelle just presented several avenues for improving existing regulation, and I have to say I concur with many of them, not with all, and I'm happy to comment on them in a minute. But before that, I would like to take perhaps one step back and briefly look at the reasoning why we need to revitalize the European securitization market and why this is so urgent. So Emmanuelle basically said that we need to boost securitization to allow banks to fund the transition and to improve the financing conditions of the real economy. And indeed, we have massive investment needs, and true, banks will have to finance the bulk of it. However, I have to admit that I do not share the view that more securitizations will necessarily help closing our investment gap. So securitization is above all a technique that allows a bank to reduce its capital requirements. And as you know, the bank is completely free to decide what it uses the saved capital for. The bank may use this advantage to lower borrowing costs for households, firms, or to hand out additional credit. However, it may also use it for trading purposes or to increase dividends and bonuses. So just to be clear, there is no automatism that a bank will use the capital relief to support in the end the real economy. And I think it's important to bear that in mind when we discuss reforms. Beyond that, I have to say that I don't see any urgency reforms that might be surprising to you. If we had a credit crunch and banks were short of capital, securitization could indeed help banks to provide additional credit. However, if we look at the data, European banks currently have ample capital headroom, so they could easily increase lending without securitizing loans. And what's more, I think important to stress that banks made record profits last year, thanks to the interest rate hikes. So if they intended to hand out more credit, they could have retained those profits, built new capital. However, they distributed the bulk of their profits, an indication for me that they expect the demand for credit to remain at the current low level. So all that to say that I don't think that we are in a hurry for reforms. We have a lack of investment, so a lack of demand for credit. And I think that fixing that lack of credit demand is beyond the means of securitization. So, but after this disclaimer, I think nevertheless it is right to look at ways to address unnecessary barriers to securitization, because when investment eventually picks up in the future, hopefully soon, banks should be able to make full use of this instrument. And that brings me to the points raised by Emmanuelle. So I think streamlining reporting requirements definitely is an issue, in particular for private securitizations, but perhaps we can discuss that later in detail. However, I would add that also data collection offers substantial room for improvement. As you know, banks are subject to a patchwork of reporting obligations, which makes it cumbersome for issuers to report, but also for investors to retrieve relevant information. So I would argue that we really need an integrated reporting framework that makes relevant information centrally available. Another big obstacle that I see, and that is holding back in particular cross-border transactions in Europe, is the fragmentation of national contract and insolvency laws, because this often prevents the creation of large homogeneous asset pools that you need to bundle together similar contracts. This fragmentation also hinders investors to purchase products issued in another member state, which is an issue for the broader capital markets union agenda, not only for securitization. And that fragmentation also puts smaller member states at a disadvantage, because they cannot reap the benefits of scale that bigger member states, such as France and Germany, have. And for me, I must say, harmonizing national laws in this regard is crucial and much more important in the end than, for example, fine-tuning the prudential treatment. On that front, I have to admit I don't have better data than regulators. There might be indeed some leeway to recalibrate, as we used to say, risk weights floor for banks, and also the capital charges for certain tranches held by insurers. However, I think if we want to remain on the prudent side and not endanger financial stability, I think the resulting modifications won't change a lot for the supply or the demand side. On this idea of creating a platform, which I think was floated in particular by the Noyer report, I have to confess that I'm a bit hesitant when it comes to issuing public guarantees. We can also discuss that later, perhaps in more detail. However, I totally agree that standardization is key. So in the EU, we just do not have a product as standardized as agency mortgage-backed securities in the US. So perhaps we need to revisit the STS label, meaning for simple, transparent, standardized securitizations, and then see how we can generate more standardization in the market. Because, of course, standardization brings economies of scale and liquidity. This is what the market needs. My last comment is on green securitization. I think that indeed green loans are a promising asset class for such a standardized European securitization product. However, I fear that the EU Green Bond Standard sets the bar just too high for securitization purposes. As we are still at an early stage of the transition, the universe of, let's say, dark green loans that fulfill the taxonomy is just too small. And therefore, I would rather go for, let's say, a lighter green, but still public label. You might have seen that the EBA recently proposed an EU label for green loans and mortgages. And I believe that this could be a smart way to reach scale.
Indeed, commendably nuanced, which is exactly the kind of discussion we want to have. Emmanuelle, Sebastian referred to the STS experience as a simple, transparent, and standardized securitization that was promoted already a number of years ago. Can you give us a little bit more of a sense of what a difference this initiative made, if any, and how you look at the experience with hindsight now that many years have passed on this? Emmanuelle, you're muted, I think.
Unmuted. Thank you, Nicolas. Thank you, Sebastian, for the remark. So on the STS experience, the take-up has been so far, from our perspective, a little bit disappointing. It is disappointing because the ABS as a global universe is still lagging behind, and because the STS, which is mainly on transparency, on procedures, but not on risk management, doesn't say whether the asset is less or more risky. It's not a proof of less riskiness, just a proof of more transparency. And among the ABS, the take-up of STS, because of the different requirements as far as the different criteria to prove the simplicity, the transparency, and the standardization, is a little bit too burdensome. What we have in mind is that we should we consider also that there might not be enough incentives in order to originate and to invest in STS because of not enough of differentiation between STS, ABS, and non-STS ones. From a regulatory perspective, including from the perspective of the originators or the investors. Just to give you a little bit of a flavor of that. When you are a bank and you invest in ABS, one you have originated or one originated by another bank, you have some liquidity requirements which can be fulfilled from the high quality and liquid asset perspective, the HQLA perspective, by different assets. ABS are eligible, but as a second tier collateral asset, HQLA asset. It's only on the bottom, so they are capped, and even the most senior tranche, the STS ones, are not able to be eligible for one intermediate tranche, which could allow to raise a little bit the caps as far as in terms of concentration in the HQLA pool. So there we consider that there's some effort to make in order to say, well, you have ABS, it's senior, and it's STS. Please provide a bonus from a regulatory perspective to those ABS, just to incentivize the STS origination. And that's the same for capital requirements, both on banks and on insurance side. And I would say that even from the Banque de France and the Eurosystem perspective, when we take collateral, the STS ABS are not handled in a different way, with less penalizing haircuts than the non-STS ABS. So here we have also something in our on our plate to deal with from a bank.
Sebastian, I was very struck, as I guess many in the audience, to hear how much the Bank of France is investing into asset-based securities and its kind of dominance of that market. Were you surprised about that? Any reactions about that element of market structure?
Well, obviously, we have a problem because the bulk of securitizations is not sold in capital markets, which is the very idea that we merge the advantages of banks in lending and of capital markets and financing, but that the banks retain, Emmanuelle has said it, even more securitizations than they place in the markets. I think it's understandable they can use it to get fresh liquidity from the central bank to fulfill their liquidity requirements. Therefore, I'm not too surprised, but I think this hints to the problem that we currently have. We need other investors than banks and central banks to invest in securitization.
And there's a question about this asking what would be the single most impactful measure that you would recommend for that? Any kind of quick answer?
Well, my quick answer would be standardization, because when we compare Europe to the US, we always mention the guarantee issued by Fannie Mae and Freddie Mac. And of course, this is quite a convincing argument for originators as well as for investors. Still, I think we pay not enough attention to the fact that Fannie Mae, Freddie Mac, so the agencies or government-sponsored entities, as they are also called, that they have driven massively the standardization of the US market for mortgages and mortgage-backed securities. And I think
it wasn't the guarantees a kind of carrot that allowed them to force standardization, right? Because there was an incentive to go through the mechanics of standardization. So what would you recommend as the main kind of commitment device? Should it be guarantees, capital relief, something else, or just you think it can be done by moral suasion? How to make it happen?
No, I would build on this STS label that we held, that we already have. And Emmanuelle said that so far it was disappointing. I agree. STS securitizations just replaced conventional securitizations and did not create a boost in the European securitization market. But I would take this STS label as a starting point and improve it, meaning strengthening it on the standardization part. So to be more explicit, the term requirements of the standardized EU securitization product should go further than the existing and include detailed provisions on standardizing representations, warranties, and also enforcement provisions. And I think this would ensure that investors can be confident that they are assuming only the economic risk of the underlying assets and not those associated with the legal details of the transaction, which is the very idea of standardization. And then we can think about what could be a perfect asset class to build this new STS label on. Emmanuelle mentioned green bonds or securitizations following the EU Green Bond Standard. As I said, I'm a bit hesitant whether the universe is large enough, and rather would say we go for a lighter touch. But happy to discuss this with you.
Yeah, maybe I would add, if you allow, Nicolas, that we have a time to market issue. So it has been like almost more than 10 years that the European financial markets have been, wandering into a zero interest rate world or very low interest rates. And it has been like 1 year, 2 years that we are coming back into normalized territories from a credit risk perspective, from an interest rate perspective.
Right.
And ABS, they are also interest rates products, and they are very sensitive to those very material aspects, which are the return versus the risk. When you have very low interest rates, so very low margins, interest rate margins to share between the originator and the investor, which was the case until very recently, there's no reward, no incentive from a return perspective in order to invest in securitization. I think that with the normalization of interest rates market, we might have a time where this return might come back to normal levels and might attract both originators and investors, which will have some flesh to something to eat in common. And this should be a little bit of a trigger, since we know that from the risk perspective, the underlying assets, the loans which are being securitized, are still very good quality loans. We don't have a lot of defaults in Europe. It is quite still, and so the risk reward perspective is very good. So it could be a very important incentive for just to trigger a new dynamic on securitization.
We have a number of questions. Briefly, Sebastian.
Just wanted to, as Nicolas, you encouraged us to have a real conversation. I would have a question to Emmanuelle, if I say, because Emmanuelle, you mentioned that going for a public guarantee, as in the US, might be one avenue to go. And I have to admit, I don't see who in Europe could provide a guarantee of a similar scale, and I don't see, to be honest, the political majority to jointly finance such a possibly European entity.
I think the Noyer report was not very specific on this. Emmanuelle, can you give us the fine print?
Yeah, maybe I would say that in my slide, I didn't mention it. In my slide, it's a question of public guarantee, because we have been torn between the proponents of such public guarantee, just like develop a system which is very American-like with the GSEs, etc., and where we consider that it might be a little bit more complicated, considering different different factors, including the fact that providing a public guarantee, it means like using public funding, which is not that obvious for a lot of different countries and that it can be also a little bit of a moral hazard type of equation, and we know
so
that
you're more cautious than Noyer in a nutshell, right?
Yeah, much more cautious.
We have thanks for making that clear. We have a bunch of very interesting questions from Christian Stiefmüller. So let me try to bundle them. So the first two questions are mostly about property markets, and as I understand them, and they are in a way related to what you just mentioned about guarantees and how the action would impact existing markets. So let me take the first two together. Have you looked, and I think that for you, Emmanuelle, have you looked at how the kind of strengthened policy frameworks that you recommend would interfere with existing products such as covered bonds, and how it would also interfere with basically I think it's a question about Noyer, right? I think his second question you just answered. So let's just talk about covered bonds, because these are very developed in some member states, as we know, Germany not only. How do you see the interaction here?
So covered bonds and RMBS, residential mortgage-backed securities, it's two competing asset classes, very, very used in Europe, in France, in Spain, in Italy, and Germany, of course, for what is covered bond, but it's a very different product. It is only a liquidity raising product. The covered bonds remain in the balance sheet of the banks, which back part of its balance sheet in the covered bond, but there is no capacity to diminish, like Sebastian was mentioning, capital requirements, but because there is no reduction in risk weight assets, contrary to ABS, asset-backed securities. So for the purpose of liquidity raising, it is a covered bond are very resilient. They have a very good investors base, and what we have seen, for instance, during COVID and until now, when there is like some risk episode, covered bond remain exactly still. They don't move. That's quite a very sure product for raising funding for banks, notably in France. And the investor base is might be very different from the investor base of ABS, which has senior tranches where there can be some commonalities, but also a lot of different junior mezzanine tranches, which are not oriented at all vis-à-vis the same investor set.
Okay.
So I think it would be a complement and not like a crowding out for between covered and ABS if we manage to revitalize ABS.
Sebastian, you're in Germany. There's a lot of sensitivities on this topic. Can you give us your take?
Well, look, I think issuing covered bond is simpler than issuing a securitization. The intermediation chain is just much more simple, and therefore the cost can be lower. I think we should not exchange covered bonds for securitizations. On the other hand, I think we have already stretched a bit the limit of covered bonds. The EU framework clearly limits the assets that are eligible as collateral. So the potential for covered bonds to grow is rather limited. Might be rightly so, but therefore we can discuss today the issue of securitization.
Maybe Nicolas, if I may, on covered,
sure.
From a financial stability perspective. Covered, it's it remains in the originator's, the bank's balance sheet, but we have an asset encumbrance problem with the very large part of covered being issued by banks. More and more by some banks. More and more covered means less and less assets which could be considered as guarantees for the senior bond holders for the rest of the balance sheet. So there's also a lot of talks, and we know that our colleagues from the Netherlands have always been very keen to say that we should put a little bit of limits to asset encumbrance, just in order to ensure that the senior bondholders remain guaranteed by the balance sheet, and that the balance sheet is not completely emptied down by covered bond, for instance.
So two more questions, which I'll again bundle together, maybe with more success, from Christian Stiefmüller. So there's a question about synthetic securitization, which we haven't discussed much. So as he mentions, a lot of the transactions at this point, he says the majority are synthetic, and they are not really capital markets unions. They are bilateral transactions, and also the counterparts in those synthetic securitization deals are a very limited bunch of investors with a lot of knowledge. So the question is both the connection with the capital markets union agenda, but also the risk of concentration. I don't know if he means it more from a financial stability purpose or perspective, or from a competition perspective, or maybe both. But can you give us a little bit of your take on what you observe in that space of synthetic securitization, maybe, Emmanuelle?
So what is interesting is that indeed there's much more activity on synthetic securitization, but from our perspective, which is related to the CMU, to the need to find some space and to find some funding in order to finance the transitions, the twin transitions, the climate transition, we consider that synthetic securitization is not the lever that we need because it doesn't address the problem. So there have been some improvement as far as the regulatory treatment and the capacity to consider synthetic as STS as well, and but we consider that we have to stick to what is really useful from a real economy perspective funding, and that the cash securitization is the one which should be improved first and foremost.
Might be also the case that this changes in the future, as we have now seen interest rate hikes. So far, liquidity was not a problem, and with the cash securitization, you get liquidity, which is not the case for the synthetic. So might be that this picture changes soon. Emmanuelle was hesitant.
We have a question from Martin Helvig. So saying if you see the asset-backed securities as a means to free bank space in bank balance sheets, how do you deal with retention requirements for the first loss tranches, which presumably bear more risk? With appropriate risk weighting, do you not get into a conflict with the need to avoid moral hazard in origination? I read it literally. Any reactions to that?
The requirement to have to retain part of the securitization, I think for our perspective, that's a very key component of the risk management and the resilience of the framework. So on that, I think there will be no discussion from our perspective to debate about the adequate level of retention, etc., etc. We should stick to it. That's a very good incentive in order to make sure that all the stakeholders have interests aligned towards a model which is very resilient for the funding of the economy. So we don't want to have something like, to originate and to get completely to drop completely any type of interest. So we will maintain this key feature from a financial stability perspective. It's very important, and there is no contradiction.
That's very clear, and I will ask Martin Helvig if he is still with us to confirm whether that answers his question or whether he has a follow-up, because I think this is an important piece of the debate. We have a question two questions actually from Pierre Raffi on the kind of international perspective, and I'm inclined to kind of broaden them even. Looking at the EU in comparison with the US and maybe from a global investor perspective, how do you see a kind of global cross-border competition to attract investor interest in this space, also vis-a-vis the US, but also vis-a-vis Japan or others that you mentioned, Canada, and how do you think in competitive terms, maybe? I'm not sure that's what Pierre exactly meant, but if it isn't, he will interject. So Emmanuelle, maybe first, and then Sebastian.
Yeah, maybe on that one, we would like a little bit more of a capacity of competition from a cross-border perspective beyond the European borders. That's not the case at all, considering the fact that securitization is very timid still. We consider that there's some flow which is very strange. When you take green bonds issuance at the global level, the European issuers stand for 40% of the global issuance of green bonds. When you take securitization, green securitization, which can be an important tool in order to fund the transition as well, it's less than 3% of the green securitization which takes place in Europe, which is originated by European actors. So there's a discrepancy.
Where is the bulk? If it's less than 3%, is the
80%.
In the US?
The 80% of the green securitization is in the US. Whether they have a minor, not a big role as far as green bond issuance. So there's quite a discrepancy that we want to sort out with that the use of this EU Green Bond label, with the use of I didn't come back on the comments by Sebastian on standardization, but for us standardization can be very cumbersome if it's not a help both for the originators and for the investors. So when we consider standardization, this should be something like a plug-in system, standardized, where even a very small bank can provide its portfolio and end up in the next day with the product completely made in the system. This is what we consider as useful standardization, which could incentivize both origination and investment. But it's if it's only in order to define additional rules and provide or implement additional requirements, this could be a little bit tricky. So we should be mindful about standardization as well.
Just to complement, not to contradict Emmanuelle, as we were talking about competition, I think we should also look at the competition within the EU, because you mentioned it earlier, the market in the EU is quite concentrated. We can read it in the reports issued by the European supervisory authorities. That's just 5 member states currently dominating the market. France and Germany sitting around this virtual table currently, but also Italy, Spain, and the Netherlands, and just 10 banking.
They also dominate, the same member states dominate the banking market and financial markets in Europe generally. So isn't that, I mean, is it different in securitization from what we see across the board in finance?
Exactly, but I think this is where we should pay attention to that. If it's not enough to just make this instrument more attractive, because that might in the end favor only a limited number of countries and already dominant market players, but it will not create an integrated securitization market within the EU. And this is why I'm so keen on making progress on harmonizing insolvency law, perhaps also some tax issues. So as you say, the broader CMU agenda, which is holding back cross-border securitization as well, both from the originator side for bundling collateral, but also for the investor side cross-border.
I was curious about your reaction to that, Emmanuelle, because I've become a little bit cynical maybe about that. I mean, how realistic is it that we could get enough harmonization of insolvency law and related issues like Sebastian just mentioned, taxation, so that cross-border securitization could become a genuine prospect in the real world market?
I must confess that it has been like since 2009 that have been working on securitization, and the very same subjects have been dealt with about standardization of those different legal aspects, including fiscal aspects. And I would, at this current stage of the Capital Markets Union and the European Union, and because of some technological developments, I would take a step away from having the single regime which would fit the 27 countries, the fiscal regime which would also erase all the borders, but takes the advantage of technology. I mentioned in the very last words of my presentation the capacity of blockchains and distributed ledger technology to help in this regard. What we have in mind is that, as you might know, we have ledgers, and the different information provided on the ledgers are captured by notably smart contracts. And those smart contracts, because of technology features, they can be designed to encapsulate a lot of different information, including a lot of different legal information, including a lot of different fiscal information. And if well designed, we could consider that, well, we haven't managed to make one regime, but maybe we can manage to have the technicalities which would allow for the users, either originator or investor, consider that it's transparent and that the technology, the IT, can manage the differences. We are confident that it can be done, and we are working hard on that, including in the space of the Euro system, where we have an experimentation program on central bank digital currency and the way it can be used in the tokenization of finance. And this includes securitization, green securitization, and what can be done in order to alleviate all the administrative and legal burdens, which are quite high and too steady obstacles.
Right. We have a question from Georges Jeu about what we discussed before, the guarantees and where to find the money for that in the context of member states being generally quite constrained fiscally. So Georges is asking, these are my words, not his. Could the EIB be the magic money tree here? Could it provide the platform that had been suggested, for example, by Noyer? How do you see the trade-offs? Maybe Sebastian first and then Emmanuelle.
Did I understand correctly? He was proposing the EIB? No.
The question is about the EIB. Could the EIB provide the platform and provide the kind of financial firepower needed for it?
Well, look, the EIB, together with the European Investment Fund as the daughter, so to say, is already active in the securitization market. So either they provide guarantees, also they invest directly in some tranches, in particular in the segment of SME securitizations. Still, I have to say that my view is that there are better methods than putting banks' credit risks on the shoulders of taxpayers. One could, for example, to give you a concrete example, I think you could expand public support for social housing, home renovations, other things, where people or companies in the real economy benefit directly. And in my view, this would be preferable to subsidizing bank securitization transactions, just in the hope that they will then lower funding costs for the real economy. I know that the programs from the EIB, they have some restrictions, conditionalities for participating banks. But issuing large-scale guarantees, I do not see it. And beyond, if you want to play in the same league as the US, I mean, Fannie Mae is alone is the largest company in the US by assets. Where does that money come from in the EU?
Some concluding words. We're almost at the hour.
Maybe on my side, I think that we are very mindful of resilience. So when we are speaking about revitalizing securitization, it's of course bearing in mind that we shouldn't be at the expense of financial stability, and that you can trust us because we are looking very on a day-to-day basis at products from our risk perspective as a central bank taking collateral, and we know that there's a undue, unwarranted discrepancy that we can fix. We should be agile and pragmatic enough in order not to stay and be completely in a state of mind which is no longer warranted at all. We are no longer in 2008. So that's I would end on that.
That's a useful consideration. I was wondering about this. We hear a lot of kind of swing of the pendulum in terms of pushing for deregulation in finance and kind of erasing what was done with the lessons of the of the great financial crisis. So thank you for this clarification. It's indeed useful. Thank you so much, actually, to both. This was a fantastically insight-ridden session. I learned a lot. I hope the same is true for our audience. Contrary to custom, we won't have another session in 2 weeks' time. That's my fault, but we'll have one in 1 month's time on the interaction between climate policy objectives and financial sector policy. So a pretty holistic look at sustainable finance frameworks, particularly in the EU, and that will be introduced by Pierre Wunsch, the governor of the National Bank of Belgium. So mark the date already. I think it's October 9, if my memory is correct. Yes, October 9. With that, thanks again once more to our speakers. Thanks to all the audience for the engagement, and have a great rest of your day. This session is adjourned.
Thanks for listening.
Thank you.